All right, so good morning, good afternoon, good evening, wherever you are. We know we have people joining from all over the world for this presentation, so we're happy to have you. Thank you for joining the Life Insurance 101 webinar. My name is Whitney Barno, and I work for the Prudential Insurance Company of America, and I'm very happy that you're joining in today. Hopefully, you will be learning more about life insurance, just generally, some information that will give you more information to make a better decision about your benefit policies. Learn a little bit more about how much coverage you may need. We'll be covering some misconceptions, common misconceptions, and things you just need to know. And then we'll talk more specifically about the life insurance that AFSPA specifically provides. So a few housekeeping things to keep in mind. You have the opportunity to type in some questions, so keep those coming in. We will be answering those throughout the presentation. We did get a lot of questions come in prior to this presentation, so we will be peppering those answers in as well. And with that, I am going to turn it over to our presenter. Her name is Nina Matias. So with that, I will turn it over to Nina.
Thank you, Whitney. Good morning, good afternoon, and good evening to everyone, all of the AFSPA members. Thank you for joining today. As Whitney so eloquently laid out, the intent of today is twofold. Number one, we want to explain to all of you just the purpose of life insurance, why it is so critically important. Definitely talk about some of the nuances that are available in general to life insurance. And then we're going to dig into the benefits that are available to you based on your membership in AFSPA. So, the first thing that I would share, and I'm going to be advancing the slides throughout the presentation for those of you that might not have the opportunity to participate via the live webinar, is the intent is to make life insurance easier. It's not the most riveting benefit, and we recognize that. It's also not necessarily top of mind for everyone, especially in a phase where the health insurance costs are rising and you're very focused on an adequate medical plan. Life insurance tends to be what we would call ancillary, tends to sometimes be an afterthought. But it really is important, depending on your life stages, whether you have a family, whether you are single. Life insurance is critical to your lifestyle and to protect those that are left behind. And hopefully the intent of today is to make sure that we impress on you all the benefits that are available to you and why it is so important. I'm going to go ahead and advance the slides, everyone. So this is Life Insurance Awareness Month. I recognize that it's the last business day of Life Insurance Awareness Month in September, but this is an industry-wide campaign. So being from Prudential and in partnership with AFSPA, we felt it was critically important to wait until this stage in September, A, to recognize Life Insurance Awareness Month, but B, to coincide with the onset of your enrollment window, which does start on October 1st. Every September, our aim is to help educate consumers on the importance of life insurance and what it does in terms of protecting your loved ones and providing financial security and peace of mind. One of the things that I'll add throughout the presentation is, number one, a thanks to those of you who have submitted questions in advance of the webinar. We've received them and we've put some work into our presentation to hopefully answer those questions just through the course of the dialogue today. But there is, as Whitney mentioned, a web chat feature. And then at the close of our presentation, we'll also be providing you with an email address. So if for some reason you still have open-ended questions, we will be sure to make sure those are addressed after the presentation is concluded. If we move on to slide 4, some life insurance facts. And this kind of helps answer the why. Why are we even talking about this? Why is it important and why should it be important to you? 40% of individuals have no idea how much coverage they need and what type of life insurance they should obtain. So we're going to talk about, again, not only the AFSPA plan, but the varying types of life insurance that are available through insurance carriers. Many consumers estimate the cost of coverage to be 3 times what it actually costs. So I think that's a misnomer that we've seen out there, that the expectation is life insurance costs a lot more than what the reality is. So hopefully throughout this presentation, we can help you feel a lot more comfortable with the fact that it's not an overly expensive benefit and it is something that's important to you. 35% of all households, which is more than 1/3, would feel that they would be adversely impacted if one or more of the primary wage earners in the household passed away. So again, what this resounding theme is going to be through our presentation is the fact that life insurance is very important. And some of these statistics are lost on a lot of people as you manage through your day-to-day functions. And again, we recognize that health insurance typically is the primary benefit that everybody places the core of their concern in. If I move on to the next slide, this is a little bit about me. We felt that it was important just to share with you why you should even listen to me, quite honestly, and why I'm here today. I've worked in the insurance industry for 20 years. I've consulted with benefit teams, for example, your AFSPA benefit team, on how to insure members, how to make sure that you are kept satisfied. I'm licensed in life insurance programs in addition to some other insurance needs. I'm based out of Roseland, New Jersey, but today I'm happy to be sitting here in the primary AFSPA headquarters in Washington, D.C. And just some general things about me outside of work. I enjoy the summer, so it's exciting to be stepping into the fall here in the Northeast of DC, New Jersey, but the summer is my time. I love the beach. I like spending time with my family, my husband and my son primarily, and I'm an animal person, so I do have 2 cats and a dog. But hopefully, again, throughout today, we really did think it was important to make you understand, I'm not just here to try to push product to you, but it is something that I truly believe in, and it's really important that you all understand that life insurance is a critical component. And I'd like to take a moment before we move on to thank the AFSPA benefits team, because they really have put a lot of time and effort for several months into making sure that this was a successful program for all of you. And, people say, and it might sound silly, but caring is at the core of what your benefits team is here to do. And they really do care about you, whether you're abroad, whether you're local. And, the partnership that we've had over the last several months with Whitney, myself, and the AFSPA benefits team has made this presentation today possible. So as I move on to the next slides, so life insurance. It's paid to your loved ones when you pass away, and it can go to anyone that you name a beneficiary. So, for example, you have spouse and children. I think that's based on your questions also that were pre-submitted. Many people tend to think, I don't have a spouse, a domestic partner, I don't have a child. Why should I even bother thinking about life insurance? There are plenty of people that just have personal friends that they name as their beneficiaries. Keep in mind, even if you're single, even if you're younger, when you pass away, whether it's unexpected or unfortunately expected in some terminal situations, someone needs to deal with your affairs afterwards. And you have the option to, choose from a myriad of people who are the ones who will get the proceeds if you pass away. So life insurance is typically intended in 3 pieces: coverage for yourself. If you do have a spouse or domestic partner, you can get coverage for them as well. And then, while it's the last thing anybody wants to think of, you can get coverage on your children. The coverage for children is typically a lower amount, and that's really designed to just help with the high expenses of funeral and burial costs. But let's think about yourself. Think of all of the income that you might bring into your household, whether it's you, whether it's a family, and think about what would happen if that income was no longer available to be brought into your household. Similarly for your spouse, if you have a working spouse, or if even you have a spouse that is home all day, which is a full-time job in and of itself, and they are there to take care of daycare, elder care, grocery shopping. Who would do that if you have to work full-time and you lose your spouse? So again, the intent of today is to kind of walk through why this is so important depending on your life stage. As I move on to the next slide, there are some common mistakes and misnomers that we would like to address when it comes to life insurance in general. Not obtaining enough coverage, being underinsured for your life circumstances. So as I mentioned earlier, you don't know, it's really difficult to understand how much life insurance you need. It's not necessarily an apples to apples comparison from your base salary to a coverage amount that mirrors your base salary. Think of all the expenses that exist, and you need to consider, are you underinsured? Are you leaving dependent children? How young are your dependent children, and how many are there? In addition, I think, individuals think it's overly complicated to buy life insurance, and it's a complicated product. There's not adequate needs sometimes to cover your dependent children. Secondary earners. Is there life insurance that's adequate to cover what the secondary earners might need as they carry through with a loss? When you're filing an insurance policy, you need to consider buying and covering the cost of burial or cremation, bills and debt, childcare, and even early adulthood, your education for your children. So when you have young children, what will happen as they grow up and they need to go to secondary education, college, tuition, and mortgage payments? Mortgage payments are sometimes critical things, and it's very, there are a lot of very unfortunate stories of what happens if a primary earner or even a secondary earner passes away without being adequately prepared. Buying life insurance from a variety of sources is a common, I'll call it a mistake, but I would like to pause and kind of add the caveat. I'm not here saying you should have one policy. But many of you, if you've rented a car, if you've traveled on an airline, there are some secondary policies that non-life insurance companies do offer. And the recommendation in general is typically it's the best to buy from a life insurance company. Now, purchasing that could be through your association. It could be through your FEGLI program, which is also the overarching FEGLI program is managed by a life insurance company. But there's guarantees there. There is just kind of peace of mind there. And it's also much easier in those situations to not have to worry about managing the variety of policies that perhaps you have through a bank or you have through your car auto insurance. So most of the time, consumers should buy insurance based on what experts would suggest from a life insurance company. Forgetting to review or update your policy. This does become a really tangible issue for certain beneficiaries, and it's been really difficult for those of us who have seen claims to have to manage through that. You might buy a life insurance policy when you first get married, when you first have a child, and then you kind of put it on autopilot. That is something that we typically don't recommend, only because there have been situations when an ex-spouse then becomes your beneficiary. You name them early on into your life, and then perhaps a divorce happens, you've remarried. Unfortunately, if your ex-spouse is listed as your beneficiary, or your elder child and you have younger family, they will inherit the proceeds, and then it's not going to where you've ultimately intended it to go. So a good recommendation is anytime you have a life event, you get married or divorced, you have a child, you have a second child, a third child, you buy a home, you should really take a step back and take a look at your policy at that time and determine if the beneficiaries that you've designated and the amounts of coverage that you have are still adequate to meet your needs. In addition to that, naming beneficiaries who are minor or incapable of making financial decisions. We're going to take some time to walk through beneficiaries as minors, and it's not to say that you should not set up adequate controls to make sure that if you want your proceeds to go to your children, they should go to your children. But there are ways to do that to protect your children getting the proceeds when the time is right, because a minor cannot be the beneficiary and actually get a lump sum proceed upon death. So we'll spend some time talking through that as well. Advancing to the next slide, beneficiary designations. I talked a lot about that, but it's kind of important, and as mentioned on the prior page, to explain what that is, right? So when you purchase a life insurance policy, you designate beneficiaries. You can designate a primary, you can also have a secondary and a tertiary beneficiary, and you can determine the limits and the amounts that you would like your beneficiaries to receive. But again, as mentioned on the prior page, and the reason that we want to reinforce this is because keeping your beneficiary designations current is critical to the well-being of your family, because what you leave behind for them, you really want to make sure that your wishes are carried through when you're no longer here to see them through. And one of the things we'll cover as we proceed, and it's really important to note, a will is not a beneficiary designation. So we'll talk a little bit about wills and trusts, but designating specifically a beneficiary is a separate process, and it's very important to ensure that that's handled as you purchase your life insurance and as you re-review your coverage amounts. As we move on to the next page, we're going to spend some time learning about what's involved as you choose and apply for life insurance. Now, the first thing I will say is life insurance is here for those who live. So, yes, you are paying a premium into something that you will not necessarily ever reap the benefits of, but it's for who you leave behind. And the reason I say not necessarily is because as we get into the AFSPA specific program, we'll talk about a few ways and a few plan enhancements in a bit that will explain some ways that you can take some of your proceeds out while you're still living. But primarily, life insurance is for those left behind. And it's really important to think about who you're leaving behind. So you focus on your family instead of just the finances. Oftentimes, families are left with hefty medical bills. We talked about credit card bills, a mortgage, future education expenses, and funeral expenses, which are, ever rising. You want to make sure that your family, upon your passing, is not left in debt. And for those of you that are out there and you don't have family, you don't have anybody that you necessarily want to leave those proceeds to, please keep in mind that there are two options here. Number one, if you're saying, why does this matter for me and why should I buy life insurance? The first thing I would say is life happens, which means today you may be out there and you might not have a family, a spouse, a child, but if you are in generally good health, you can typically get a very low cost life insurance program without any medical evidence or with minimal medical evidence. And if you're in good health, you're going to be able to see that coverage approved. And that will protect you in the event that you do meet a spouse, you do have children later in life. And at that point, if that does happen and you don't have, maybe, you got an illness of some sort, it's just going to be harder and potentially more costly to get life insurance at that time. So that's one reason. The second reason is if you have a passion. We've seen people that have just left something behind for a friend or someone that cares about them to cover their medical expenses or burial costs. But in addition, you can set up a trust to have the money be donated perhaps to, a passion in the arts or animals or something that you really feel, a charity of your choice where you'd like to leave that behind. I've seen people that have been very active in their churches, for example, that they've chosen to leave a portion or all of their benefit behind to a church or a charity. Choose a legacy. Leave a meaningful amount to people you love because you care about them and you want to make sure you're protecting them. Life insurance, and it's important to note, in general, life insurance, the proceeds are not taxable. I do know, and we'll talk a little bit about the varying types of life insurance. There's term life, which we'll get into, and there's whole life, but there are different taxable amounts based on cash value, which I'll get into, but life insurance itself is not a taxable benefit. And then cash value. Cash value is a piece that's tied to what we call a whole life component, which I will get into. The whole life component is not necessarily what's provided through your FEGLI program or through the AFSPA benefit, but it's still important, and it's important to your benefits team that you understand the options that you have available to you, even beyond what might be given through your association or through the FEGLI program. As I advance to slide 10, as we've touched upon, no matter what stage of life you're in, what we're trying to impress upon you is it is really important to have adequate coverage. If you're single without children, you're starting to maintain a lifestyle. You want to be able to live your life without worry of what's left behind, perhaps for your parents or for friends or family members. There's debt early on. There's student loan debt. There could be just credit card debt, anything that you carried with you from college, for example. And there's always a cost for a funeral. If you're married with children, this is where most of the time individuals will find that they need the bulk of their life insurance. Paying off the mortgage, college funds for your children, cost of child care, with your spouse being the sole caretaker, how is he or she going to ensure that they're recovering from the loss of your income? And just day-to-day items. Again, life happens, and that's one of the things that I ask that you keep in mind here, because you need to be able to prepare for the unexpected. Divorce or remarried. Quite often, divorce settlements will require that a specific amount be maintained for your ex-spouse, domestic partner. And then that's a life event. That's an important time to think of the fact that if you have a new spouse in your life or a new significant other, you might want to also purchase additional insurance to leave something behind for that person. and married and retired. The one thing I will add for everyone is I know that a lot of you who are looking into retirement are wondering how much you should have. It's an interesting question. It's a difficult question. It's one that I cannot specifically answer, but we can help give you guidance. And the reason I can't answer it is just because, quite honestly, there are some compliance regulations around me giving you actual advice or guidance, but we can give you the tools to help you decide what's the most appropriate for you. Whether you're retired or not, it still is important, and you're going to hear me saying this time and time again, everyone. Life insurance is critical. And it's, again, think of those who live and think of everyone in your life that you want to make sure is adequately protected. As we move on to the next slide, and this is what I was just briefly mentioning, how much coverage is right? And it's not a simple answer. So in general, typically at Prudential, we've said, 7 to 10 times your annual gross salary is what normally makes sense to carry in life insurance. And you could calculate your long-term financial obligations and subtract whatever your assets are. The remainder in that gap is where your life insurance would come in and need to play a critical component to helping secure and close that gap. For example, let's think about what your immediate expenses are. Let's think about funeral costs, mortgage, debt, all the items that I mentioned earlier, uncovered medical costs. Secondly, what are the ongoing expenses going to look like? And that's basic day-to-day things that sometimes don't come top of mind when you think about life insurance. Food, housing, transportation, healthcare, clothing, and all other vehicles of insurance that are not necessarily life insurance. And then what are your future expenses? College, retirement for your loved ones, and making sure that you're leaving something behind for them so that they can live as comfortably as possible. And when you come up with all of those calculations, then as an example, you can think of subtracting what your spouse has as earnings, what the investments are that you already have played into, and the balance is typically what the amount of life insurance is that you should look into. Advancing the slide. One moment, please. Thanks, everybody. Life insurance policies. So there are two main types of life insurance policies. There's term policies and there are permanent policies. The term policies are more affordable. They're what's typically offered through a group insurance program. So your FEGLI program, your benefits that are offered through AFSPA, those are term policies. They're more affordable. They cover short-term needs, usually of 30 years or less. For the FEGLI program and for the AFSPA program, they don't necessarily have a 10, 20, 30-year term, but instead they're going to cover you for the duration of your tenure or to a specific age. For example, the AFSPA life insurance program provided and administered by Prudential, it carries through age 80. So those are just some different rules to think about. But in addition, if you chose to go to a life insurance company and buy your own term policy individual, normally those would be a 10-year term, a 20-year term, a 30-year term. And in those situations, what you really want to think about is what you expect in terms of your life events over the next 10, 20, 30 years so that you can align your term policy to whatever your life situation is going to be. And the others are permanent policies. Those permanent policies, also known commonly as whole life policies, they build value. So there's a cash value that gets built on the side, and they're for needs that tend to last indefinitely. So, think of a permanent policy, AKA whole life. It lasts for the whole of your life. So if we talk more about the permanent policies, what types are there? There's a whole life policy. They do carry higher premiums, and that's just the reality because they're lasting for the whole of your life. But they also build cash value on the side. So some individuals find that the cash value is helpful for them because there's an option perhaps to take some of that cash value out. If you want to cover some expenses while you're living, you have a little bit that's built there. And then there's also universal life and variable universal life. The universal life is a premium schedule that you choose, and it also earns interest over time. And the variable universal life gives you flexibility of a universal life policy with an investment element. So what I would share in terms of that, and I do recognize that some of the questions in advance asked specifically about policies that also allow for an investment vehicle, are policies with an investment vehicle are totally intended to be life insurance first, and you do need to keep that in mind. They're not intended to be investment first, life insurance second. Life insurance is still the primary mechanism, and the investment comes secondary. And one of the things I will offer here is Prudential is working very closely with the AFSPA benefits team to provide more resources for you in the future, and we're building that now, which will give you access to Prudential financial advisors who are licensed to be able to talk with you more about some options that could potentially be available based on your life stages and some policies that you might want to consider. So that those assets, or excuse me, those features are not yet available, but please be on the lookout, and your AFSPA team will make those available as we continue to develop just some basic tools to help you with your overall financial wellness, and also help to provide access to a licensed Prudential advisor that can talk with you more about these permanent policies and what your options are. A few additional items you should know. So accelerated benefit option. This exists today in both your FEGLI plan as well as the AFSPA plan that's provided through Prudential. With accelerated benefit option means it allows you to access a portion of your benefit prior to your death in specific circumstances. When we talk in detail about some of the new exciting changes to the AFSPA benefit plan, we'll explain what this benefit is, and we'll also talk about how that benefit has been enhanced. A few other things, group rates. So group insurance is what you have today through your AFSPA benefit plan, and it is also what you have through your FEGLI plan. Group rates, because you're all coming together as a group for things in addition to life insurance, but life insurance does tend to be one of those benefits. It's a plan that covers a low premium. So typically, you're paying a lower premium through your group program than you would if you look to get insurance through the street. And then underwriting. There are certain amounts, which we'll talk about, which are guaranteed issued, provided there's certain parameters. And beyond that, if you look for higher coverage, or if you're in a certain age bracket, you'll need to provide proof of good health. That's an industry standard, and it just looks through your current health, your medical history, family history, lifestyle, to ensure that the coverage that you're looking for is applied to the proper risk, to ensure that you're being medically underwritten correctly. And that's more a requirement on the insurance company side, and it helps us keep the group rates affordable for the entire plan. If we advance to the next slide, we're going to spend a little bit of time talking about wealth transfer. So this is where life insurance does get a little bit into the nitty-gritty. I'm going to try to keep it as high level for you as possible. But, the reality is you work hard to have the level of lifestyle that you've created for yourself and that you've created for your family. And you want to make sure that you're keeping that established lifestyle for your loved ones after you're gone, whether, you again, prepare for the unexpected. There's a number of wealth objectives. The lifestyles I mentioned, your heirs, your family, there could be a significant reduction in your family's income. Life insurance can help you replace your lost earning power. And immediate liquidity. So liquidity means you need access to those dollars, or your family needs access to those dollars upon death. The death benefit, as we've covered several times and mentioned, there's debt, there's mortgage, there's expenses, those that you expect and those that you could have never foreseen. And the access to liquid cash when someone passes away is really, really important. Sometimes assets can get tied up and it gets very difficult and time consuming to get those out. So wealth transfers help provide immediate liquidity. Help to equalize estate distribution. So when you have balance inheritances for your heirs, for example, you have a child that is getting the family business or anything else that's going to one primary child, do you want to make sure that your other children are adequately protected and given maybe a similar monetary amount through your life insurance program? So wealth transfer can help do that. Increase bequests. So premium payments are sometimes considerably less than the death benefit you purchase. Normally, that's going to be the case. You're able to give your larger gift to charities or family members and purchase assets from or loans to your estate. Current tax laws mean an estate above a certain financial threshold can be significantly reduced by federal and state death taxes. And as you can see on the slide, that can approach 25 to 45% of its value. Life insurance can help provide liquidity to cover those tax expenses. So why is a wealth transfer important? Hopefully the slides that we just covered give you a little bit of insight into that, but it allows you to transfer your assets to the people and or organizations of your choice. And think of it in one regard as you want to set things up now so that your wishes are carried through when you're no longer here to oversee them. So it's about a strategy that continues your legacy. It allows you to make sure that the importance of reducing legal entanglements, covering whatever taxes may come and settling an estate or anything of that nature, while also increasing the amount of wealth that gets transferred to your beneficiaries. A strategy that you may want to consider, and you can do so with a financial advisor, you can do so through consulting with estate attorneys, is using a will, having a trust, designating a power of attorney. Wills can be, you have a will, you also have a living will, and life insurance or another funding source. So last will and testament. As we mentioned when we first started talking about beneficiaries, a last will and testament is important. It does not replace the purpose for life insurance of designating your beneficiary. You do need to have a beneficiary designation outside of your will to make sure that your life insurance proceeds are being received by the individuals that you intend to receive them. But a will, as it shows here, allows your wishes for the distribution of your property to be carried forward, and it identifies who's going to manage the distribution, who's going to care for your children. If you don't have a will, state laws are going to dictate how this is handled. So again, this goes back to me explaining earlier, you've worked hard to maintain a certain lifestyle. You know what your wishes are, but in lieu of a will, you might not, there could be unintended implications of where your proceeds end up. So let's spend some time talking a little bit about trusts. I'm going to mention first, because we use some comments about probates throughout here. Sometimes it's necessary, depending on your assets, for the courts to oversee your assets, and that's where a probate's going to come in. It's a legal process to make sure that all of your debts and all of your insurance and funds are properly settled. And a trust is part of what you need to be aware of if your situation if a probate is involved with your situation. It's a legal arrangement. It's usually a written document under which one party, which is the trustee, maintains property for the benefit of others, and those are the beneficiaries. So a trust can be a prudent way to hold and distribute assets. Depending on the type of trust that's established, which we'll get into, it can simplify financial life, reduce your estate taxes, and then allow for greater control and asset management after you pass away. There are varied uses and purposes. So again, mine is not to provide you with advice on this, but just to explain what they are, and then to give you the option to kind of consider how you want to handle your proceeds, your assets following this discussion. But trusts have varied uses and purposes. They can be established during your life for your own benefit or the benefit of others, not only during death, but some are drafted for flexibility to give to the grantor. Others focus on tax savings. And there are two major classes of trusts. There's a revocable trust and an irrevocable trust. Not, for some reason, that's not the easiest thing to say for me. But we're going to talk about those. A revocable living trust is created during your lifetime. It allows you to maintain the control of the trust during your life, which means there's instruments for you to manage your individual assets during your life, and then also in the event of a disability. What are the advantages and the disadvantages of having trusts? And again, I am not here telling you one is better than the other, but it's very important for you to understand what the importance is and just to be very aware of what helps, what doesn't help, so you can make an educated decision. Reduction of the probate cost. So as we mentioned, that's the legality. That's where you need to probably have a court intervene, and sometimes that can be costly, it can be time consuming, it can be stressful. Having a trust helps with those costs. Elimination of the delays that I just mentioned. Advocacy of multiple probate proceedings, because sometimes it's not just a once and done situation, especially if there's a high volume of assets. And management of your property, in the event of a disability. The disadvantages are there's cost involved if you're creating a revocable living trust. Probate proceedings may be unavoidable. So even if you're trying to minimize those, sometimes it's a given and it's going to happen depending on what your estates and what your proceeds are. Funding the revocable living trust can be time consuming. So those are all things, advantages and disadvantages that you need to consider as you think about whether a trust is right for you. There's also an irrevocable living trust. The intent here is typically to take care of tax implications in situations where your estate is taxable, but the transfer is permanent, meaning once you create the trust, you're giving up all control and ownership to the assets of whomever you've granted that to. As we move into the next slide, after speaking about trusts, this is just a seamless slide to talk about life insurance when you do have minor children, as we mentioned earlier. Yes, you can list your minor children as your beneficiaries. So, the last thing you want to do is set something up and then your children are left without the proceeds. But how do you do that? Life insurance proceeds cannot be released to a minor child. They're going to be dispersed to a legal guardian who manages the financial assets, or an adult who's responsible for the well-being of that minor beneficiary under applicable Uniform Transfer to Minor Act. Prudential in those situations, or whomever your insurance carrier is, would hold that trust information until the legal age. So one thing that is commonly done is a trust is set up for your minor children, but in some situations, the person who becomes the person who's responsible for caring for your children, I've also seen them be named as the beneficiary who then manages the proceeds for your children until they become of legal age. There's, the choice is definitely up to all of you. So again, this is not intended to provide you with advice, but information for those of you that have minor children. As we advance to the next slide, everyone, what's holding you back? Hopefully this has given you some additional insight into why it's very important to have life insurance, but if not, 1 in 4 people feel they need more life insurance protection. I've worked in insurance for almost 2 decades, and even with myself, every now and then I step back and realize maybe I'm not adequately protected. So I do spend a considerable amount of time working to make sure that as my child ages and as my life stages evolve, I'm monitoring my benefits to ensure that I feel I have adequate protection and I have peace of mind if the unexpected were to happen. Whether you need more insurance or you're applying for the first time, AFSPA makes it really easy to apply. And as I mentioned when we opened the discussion, that's one of the things that's been very helpful through the several months of planning. There's been a lot of thought and consideration into the fact that you're all very busy individuals, and there should be ease and very little administrative burden in you applying through the program that's offered through AFSPA. So now it's the time where we get to talk about the AFSPA insurance plan. And it's what you've probably heard and what's referred to as the GEL plan, which is the group enhanced life insurance, which is a benefit of your AFSPA membership. So again, we've talked about several different components of life insurance that you can certainly look into to buy to supplement your program, and that also supplements your FEGLI program. But keep in mind Members 19 through 59 can enroll from $50,000 to $200,000 in coverage without any medical underwriting. So one of the questions that had come through in advance was an individual who was within this age range that had trouble in the past with the medical evidence component due to a weight restriction. The first thing that I will offer to all of you is while our weight restrictions, if you do need to submit medical evidence, are proprietary guidelines, and I'm not even aware of them, we do have very, very generous guidelines and very generous ranges. But now is the time for anyone that's between 19 and 59 to say you can get up to $200,000 in coverage without ever even having to answer those medical evidence questions. The newest feature, which is really, really exciting, is that enhanced accelerated benefit option that I mentioned earlier. Let me explain what exists today in the AFSPA plan, and then I'll talk about how it's been enhanced through this GEL program. An enhanced accelerated benefit option allows you to take a portion of your proceeds out while you're still living if you're unable to perform 2 activities of daily living. That's the enhanced program that's offered through the GEL Life Insurance, and it's really, really exciting to talk about. It does not replace, but it supplements the existing accelerated benefit option, which basically says if you are terminally ill and you have a life expectancy of 12 months or less, you can take out a certain portion of your proceeds up to a maximum amount while you're living. That still exists. This is just an evolution of that to say you don't have to be terminally ill, but if you're unable to perform 2 activities of daily living, let's say toileting, bathing, if you can't do those, then you can also take a portion of your proceeds out. And the intent there is for you to use the money while you're living to cover perhaps, maybe you need daycare costs. Maybe you need, someone in-house to help you with your day-to-day living. I recognize that there were some questions on long-term care. Now, while this is not a long-term care supplement, some people liken it to that. And again, I'm not here to suggest that it is a long-term care supplement, but there are some benefits to being able to have this enhanced accelerated benefit option to use it for things that maybe long-term care benefits would also provide to you, such as, in-house caregiving. There's more coverage for your dependents in this plan also. So you can elect up to $25,000 of coverage for your spouse or domestic partner and $10,000 or $20,000 for your dependent children, again, without medical underwriting. Some of the great news also is all of these enhancements that were worked on very hard by your benefits team had you in mind, and they're very, very, very not cost prohibitive, but cost smart for all of you. That you still also have your immediate benefit plan. This is something, and I will share with you, that is not necessarily available to all associations, to all employees that work for employers. And it's something that you should really appreciate that's provided to you from your AFSPA group, because it gives you a lump sum, your beneficiary, of up to $15,000 within 2 business days. That is a very, very rare offering, but it makes sure that the money is provided to you in a format and, more importantly, in a time component that gives you instant access to those dollars to help with funeral costs or any kind of expenses. And the accidental death and dismemberment insurance. So in addition to basic and supplemental life insurance for you and your families, there's if you pass away due to an accidental death, or if you have, based on schedule, certain dismemberment, which sounds very morbid, but we are talking about life insurance, you can receive an additional benefit with coverage amounts ranging from $10,000 to $600,000. We appreciate your time today, and what we've been monitoring the questions that have come through this broadcast today, and we've also done a lot of work to make sure that we've covered your questions that you've submitted prior to this webinar. But if you do have additional questions, the AFSPA Association is here to help you. What we recommend is there is a number, and there's also life@afspa.org. Whitney and I are here and to partner with the AFSPA benefits team. So as your questions come in, we will be working closely with the team to make sure they're answered adequately and then released back to you. If there's nothing else, ladies and gentlemen, what I would say is I thank you very much for your time today. There is the webinar that we've covered today will be available for recording. And what I'm quickly doing is just scanning through the questions that you've submitted. I think we've provided more information about the GEL enhanced life insurance. One of the questions that you asked is, what are the circumstances in which life insurance will not pay benefits? Well, one of the things I will say is through the AFSPA plan, there are no exclusions. So that's one of the really great benefits to having the life insurance program and signing up through the AFSPA program. I know that there were a lot of questions about the FEGLI program. I'm familiar with it. I'm not able to necessarily give advice, but that was why one of the things I mentioned early on is we're working with the benefits team to ensure that we give you some additional resources and tools that will help you speak to a licensed benefits advisor if you choose to do so. What we will also be doing is working with the team to scan through these questions and to send them out as a follow-up. Anything that has not been adequately answered, the questions that you've pre-submitted, in addition to the questions that you may ask as a follow-up to this or after you listen to the recorded webinar, can be released back out to the group. And please, for myself, for the benefits team, it's really helpful for us to make sure we hear your feedback. And we'd ask that you send that through outreach@afspa.org. The only way that we can make sure that we're meeting your needs and regularly evolving the benefits program and providing you with information that's critical to meet your needs and those of your family is if we hear directly from you. And we take it very seriously. So again, I thank you all so much for participating today or for listening to the playback. And I wish you a wonderful weekend. Take care, everyone.